Our next topic of discussion is income from other sources. So here we'll be seeing deductions allowed against income from other sources. So what mainly consists of income from other sources? It includes mostly the passive form of income for an assessee, like dividend, interest, commission, and other expenses, which does not fit under any of the four heads of income. So the first will be deductions allowed under section 57. So this five heads being the income, what are all the expenses allowed against the same? For dividend, any amount paid as commission or remuneration to a banker or any other person for receiving this dividend can be allowed as an expense. So it should be solely for the purpose of receiving that particular income, only then the reduction will be allowed. Second is income consists of recovery from employees as contribution to any PF superannuation. So only if it is paid within due date under respective acts. So it should be paid within, if PF has a particular date, then it should be paid within that due date and not as per 43B. For any contribution to employees fund, we have to check 36 months section applicability and not 43B applicability. So the due date should be act specific and not as per 43B, which is before 139(1) filing of return due date. Next is income from letting of machinery on hire with or without building. So what can be the expenses? Insurance premium can be an expense, depreciation can be an expense, or any unabsorbed depreciation or any repairs to such machinery, plant or building can be claimed as an expense. Next is family pension. Sum equal to 33.33, that is 33 1/3 percentage of such income, or 15,000, whichever is less. Interest on compensation or enhanced compensation, 50% of such interest income. So this does not cover amount received on compulsory acquisition or amount compensation as such received. Rather, it talks about interest on such compensation or interest on such enhanced compensation. So only on the interest amount there is 50% of deduction available, irrespective of the actual expenses incurred against the same. So what are all the conditions when deductions will not be allowed is covered under 58 section. So first is personal expense. If you read the list of expenses that is not allowed as a deduction, it will be mostly like it will maximum match with what is available in our PGBP deductions. So as per section 37, for PGBP, personal expense is not allowed. Same for income for other sources. Deductions not allowed under section 58 covers personal expenses. Next is interest payable outside India, TDS, that is tax at source not deducted. The same provision is available in income from house property. Deduction will not be available if interest is payable outside India and TDS is not deducted. Third is excessive or unreasonable payment made to related person. Again, the same is available in PGBP 48(2)B. Whenever you have paid an amount excess to the market rate, say in general you have an employee to whom an amount of 20,000 is paid, whereas similar employee cadre, you are paying only 15,000 to an unrelated party, then that 5,000 will be considered as unreasonable or excessive. Fourth point is payment above 10,000 made to a person. So if on a single day to a single person, it can be multiple payments in a single day. However, in a single day to a single person, if you have made above rupees 10,000, otherwise than in the allowed modes. What are all the allowed modes? Account payee check, draft, or ECS, or any other electronic mode. This is same as 48(3) available in PGBP. Next is expenditure in connection with lottery. So whenever you have an income in nature of lottery, races, or crossword puzzles, gambling, or betting of any nature, then such expense will also be not allowed. The final one is 30% of the expenditure. So 40 if you remember in PGBP, whenever TDS is not deducted on expenses subject to tax at source, if the same is not deducted, 30% of the total expenditure will be disallowed. Our next topic is bond washing transaction and dividend stripping. So the date of transaction is prescribed. The record date here mentioned in this diagram is nothing but the date on which the company has paid the dividend. So here it is the date on which dividend or interest, any form of income has accrued to the transfer or transferring in this case. So if you have sold, it is an and condition. So if you have bought any shares or securities within 3 months of the record date and you have sold it within 3 months, the securities there is a limit of 3 months, and for units it's 9 months, then it is called as dividend stripping, where the loss, the entire interest or dividend is actually should be exempted in the hands of the owner of the securities or the units. Then the loss should be limited to the amount of dividend or interest earned. And here, if you read the concept of sold sometime before the due date of interest, then it is same as to the concept of deemed ownership. The interest income will be taxed in the hands of transferor. If you remember the deemed ownership concept in house property or clubbing of income in the nature in our other lesson, you will remember in certain scenarios the transfer will not be considered. Same as here, if you have sold sometime before the due date of interest and reacquired it after the due date is over, then the interest income should be taxed in the hands of transferor, because this might be an arrangement for taxation avoidance. So with an example, we'll close the chapter. The first one is cash gift of 51,000 received from her friend, that is Mrs. Hemali, on occasion of her Sashti of the Purti, a wedding function celebrated on her husband completing 60 years of age. This was also her 25th wedding anniversary. So now, wedding anniversary is not counted. Only wedding, on the occasion of wedding, if any gift is received, then the same is exempt. So in this case, it is not exempt, the same is taxable. In the next question, if you see on the same occasion, so it is not exempt. As of now, any income earned is not exempt. Diamond necklace worth 2 lakh was presented in her sister, so it is relative. Any amount received from a sister, or sorry, from a relative, is not taxable. So in this case, it is not taxable. Plus the amount here is above 50,000, only then it is taxable. Final point is that when she celebrated her daughter's wedding, okay, so only on individual's wedding it is exempted, not on their son or daughter's wedding it cannot be exempted. So we'll have to check that condition also. The next viewpoint is that value of fixed deposit was there was a fixed deposit made by the daughter's friend. So now we'll have to check whether fixed deposit fall under the category of sum of money above 50,000 or not. So whenever you write an answer like this, write both point of view. That one, if it is considered as a sum of money, then it is taxable. However, if it is not a sum of money and the same does not fall under the purview of property, the same cannot be taxable. Plus, the question concentrates on the word compute the income. So once you write each point describing, make a table in particulars against each point, write the notes, and make sure you compute the total income, or income in this case for income from other sources, uh, for the both the scenarios specifically. One, if it is considered as sum of money, then include it. If not, do not include. Only 51,000 will be income from other sources total. So thank you. Give all the details as much as possible in your examination answer sheets.